Hi friends, welcome back to Striving Aspirants. In this video presentation, we are looking into the activity or turnover ratios. Let us check what is activity or turnover ratios. The activity or turnover ratios depicts the capacity of business to make more sales or turnover. In other words, we can say these ratios will evaluate the efficiency of a business. Means how the assets are utilized or how the assets are managed in a business, and number of times assets used or any constant of assets used for the sales during an accounting period. To make it simple, we can say it indicates the frequency of sales with respect to its assets. These assets may be capital assets or working capital or average inventory. If we have higher turnover ratio, we can say there is better utilization of assets in an organization, which signifies the improved efficiency. Because of that, it is also called as efficiency or performance ratios. And the effective utilization of assets, which will lead to better profit to the organization. From all the points we have seen above, we can conclude that the activity or turnover ratios calculation, we have to refer sales or cost of goods sold, and which will be expressed in terms of rate or number of times. The important activity ratios constitute the following: stock or inventory turnover ratio, debtors or receivable turnover ratio, creditors or payable turnover ratio, and investment or net assets turnover ratio, which constitute fixed asset turnover and working capital turnover. Let us check the stock or inventory turnover ratio. As the name indicates, this ratio deals with the stock or the finished goods a company is dealing with and the products sold by a company in an accounting period. In other words, we can say it is the relationship between cost of goods sold or sales and the stock of goods or the average stock. This is the calculation formula. Stock turnover ratio equal to cost of goods sold or sales divided by average stock or inventory. And average stock equal to opening stock plus closing stock divided by 2. And the cost of goods sold means sales minus the gross profit value. Stock turnover determines how many times stock is purchased or replaced during a year. When there is low turnover of stock due to bad buying or the stock obsolescence, that is a bad or dangerous signal. And when there is high turnover, it is a good signal, but it should be carefully note that might be due to buying in small lots or selling quickly at low margin to realize the cash. Next one is debtors or receivables turnover ratios. When a business is selling goods on credit basis, the customers are created, and related to customers, or we can say the debtors, they will be paying the amount in a future date. So the receivables are created here. Liquidity position of a business depends upon the speed at which the receivables are collected. In other words, debtors turnover ratio talks about collection of the money from the debtors or the customers and the credit policies of the firm. It expresses the relationship between credit sales and debtors. The calculation is debt turnover ratio equal to net credit sales divided by average accounts receivable. And the average account receivable equal to opening debtors and bills receivable plus closing debtors and bills receivable divided by 2. That is the average accounts receivable. This ratio indicates the number of times the receivables are turned over and converted into cash in an accounting period. Higher turnover means speedy collection from debtors. This ratio also helps in working out the average collection period. Ratio calculated by dividing the days, months in a year by debtors turnover ratio. Next one is creditors or payable turnover ratio. Like the debtors or receivables turnover ratio, here when a firm is having credit purchase, in that case the accounts payables are created. In other words, this is the relationship between credit purchase and accounts payable. The calculation formula is creditors turnover ratio equal to net credit purchase divided by average accounts payable, and the average accounts payable equal to opening creditors and bills payable plus closing creditors and bills payable divided by 2. When there is a low ratio here, it means the credit is allowed by supplier for a long time, or it may reflect delayed payment to suppliers, which is not a good policy, which will affect the reputation of a business when the payment is delayed to suppliers. The average period of payment can be worked out by days or months in a year by the turnover rate. Finally, we will see what is investment or net assets turnover ratio, which is also called as capital turnover ratio. This is the relationship between sales and capital employed. So the calculation formula is investment or net assets or capital turnover ratio equal to net sales divided by capital employed. This capital turnover ratio, which can be studied by analyzing the following 2 turnover ratios, which include fixed asset turnover and working capital turnover. Fixed asset turnover means net sales by net fixed asset, and working capital turnover means net sales divided by working capital. Here, when there is a high turnover or capital employed, working capital and fixed asset is a good sign and implied the efficient utilization of resource. Higher turnover reflects the efficient utilization resulting into higher liquidity, means cash position and profit or profitability of the business. That's all about the activity or turnover ratios. So it's bye from Striving Aspirants. We will see in another video presentation. Till then, take care and subscribe our channel Striving Aspirants. Bye bye.